Intel's stock just jumped nearly 6% in a single trading session, and most of the commentary you'll see online will either call it a moonshot or a dead cat bounce without explaining anything useful. Here's what's actually worth your attention. A 6% move on above-average volume in a large-cap stock is not noise. It means institutional money moved deliberately. The question serious investors need to answer is not whether to feel excited or skeptical. It's this. Does the catalyst that triggered this move actually change Intel's earnings trajectory, or is the market repricing emotion? Let's get specific about what moved Intel today, because vague attribution is how retail investors get burned. As of June 25, 2026, INTC's move came on a combination of factors that converged in the same session, the kind of confluence that professional traders watch for, because single catalyst moves are easier to fade than multi-factor ones. First, Intel received a significant update related to its U.S. government foundry contracts under the CHIPS Act framework. Confirmation of progress on domestic semiconductor manufacturing subsidies gave the market a concrete reason to revisit Intel's Foundry as a Service segment, Intel Foundry Services, or IFS, which has been the most scrutinized and most doubted part of CEO Pat Gelsinger's original turnaround thesis, now being carried forward under new leadership. Following the executive changes, Intel navigated in late 2024 and into 2025. Second, there were credible reports circulating among institutional research desks, not just retail speculation, that Intel secured or is near finalizing a meaningful external customer commitment for its 18A process node. This matters enormously. Intel's entire foundry credibility hinges on whether any serious customer, a company that could otherwise go to TSMC, chooses Intel's fabrication. One confirmed anchor customer changes the yield risk math for every subsequent client. Third, broader semiconductor sector tailwinds were already in play. The Philadelphia Semiconductor Index was up on the session before Intel even opened, providing a rising tide backdrop that amplified Intel's stock-specific catalyst. The actionable insight here is structural. When you see a large-cap stock move 6%, always identify whether the catalyst is operational, meaning it affects revenue or margins, or purely sentiment-driven. Today's move has at least a partial operational basis. That makes it more defensible than a meme-driven spike. A 6% move demands a fundamental audit. So let's run one, because this is not financial advice. It's pattern recognition, grounded in publicly available data. Intel's market cap heading into today was approximately in the $90 to $100 billion range, a dramatic compression from its all-time highs above $290 billion in early 2021. The stock has been in a multi-year value trap debate. Is it a turnaround play with asymmetric upside, or a melting ice cube in a world where TSMC controls advanced node manufacturing and AMD has taken meaningful x86 market share? Here is where it gets nuanced. Intel's gross margins have been under severe pressure. In recent quarterly reports, gross margins dipped into the high 30s to low 40s percentage range, well below historical norms above 55%. Every dollar Intel spends building out its foundry infrastructure is a dollar that compresses near-term profitability. The market has been penalizing Intel for spending that it hasn't yet proven will generate returns. Today's catalyst, if the 18A customer news and CHIPS Act progress are verified, begins to address that return question. If Intel can show that its capital expenditure is converting into contracted revenue, the margin compression narrative shifts from indefinite to temporary. That is a meaningful re-rating trigger. But here's the honest counterweight. Intel still faces a 2 to 3 year runway before 18A can realistically generate foundry revenue at scale. AMD's Zen architecture continues to gain enterprise and data center share. And NVIDIA's dominance in AI accelerators means Intel's Gaudi GPU ambitions face an extraordinarily high bar. So is today's 6% justified? Partially. The move reflects a reduction in the probability of the worst-case scenario, not confirmation of the bull case. Those are very different things. Investors who chase this expecting a straight line to recovery will be disappointed. Investors who understand they're buying a recalibrated probability distribution on a turnaround have a more defensible thesis. If you're earlier in your investing journey, today's Intel move is a textbook lesson in 3 concepts that separate reactive investors from deliberate ones. Pay attention here because this framework applies to every large-cap catalyst event you'll ever analyze. Lesson 1. Volume confirms conviction. Today's INTC move was not just a 6% price change. It happened on above-average volume. That distinction is critical. A 6% move on thin volume could be a few large orders distorting price with no follow-through. A 6% move on heavy volume means institutional participants, funds managing billions, were actively repositioning. They have research teams, they have access to management calls, and they are not momentum tourists. Heavy volume on a catalyst day is the market telling you the information is being taken seriously at the professional level. Lesson 2. Never conflate a stock's move with the company's performance. Intel, the company, did not become 6% more valuable in its operations today. What changed is the market's collective assessment of Intel's future earnings probability. Those are related but not identical. This is why you can have a great company with a falling stock and a struggling company with a rising one. Prices reflect expectations, not current reality. Lesson 3. Understand the difference between a trading catalyst and an investment thesis. Today's move is a trading catalyst, specific time-bounded news that creates short-term price action. An investment thesis is a durable, multi-year view on why a company's intrinsic value will grow. Before you act on any 6% move, ask yourself which one you're responding to. There's nothing wrong with either approach, but conflating them is how investors end up holding positions they don't understand through drawdowns they didn't anticipate. The practical move right now, regardless of your view on Intel, is to add this to your research queue, not your portfolio. Watch the next earnings call. Watch whether the 18A customer news gets confirmed with specificity. Watch whether gross margin guidance improves. Data first, capital second. That's how durable wealth is built. So here's where we land. Intel's 6% move today is not irrational, but it is not vindication of a full turnaround either. It is the market repricing the probability of failure. And those are very different things. The open question we haven't fully answered is this: can Intel's 18A node actually compete with TSMC N2 on yield and cost at scale? That's the video we're building next. Subscribe so you don't miss it. And if this gave you a cleaner framework for reading Catalyst Days, hit like.